Last Friday, August 29th, we got big news on the inflation front. The Fed's favorite inflation report came out, and it could shape what happens to interest rates next month. Here's what you need to know. The Corp PCE, that's Fed's go-to inflation measure, came in at 2.9% year over year. Now, why does that matter? If inflation stays high, the Fed is less likely to cut the rates. But if the economy cools down, a cut becomes more likely. Fed Chair Jerome Powell even said they're getting closer to cutting depending on the data. With this report showing no surprises, markets are seeing a 90% probability that a Fed rate cut is still on the table for the September 17th meeting. But this week, on September 5th, we get the August job report that could tip the scales in a different direction. A quick refresher, the Fed doesn't directly set the mortgage rates. They set the federal funds rate, which affects short-term lending between the banks. Mortgage rates, however, move more with the bond market and are loosely tied to the 10-year Treasury yield. But Fed policy definitely plays a role. On the housing side, signed contracts for the homes dipped a bit in July, but keep in mind that was before mortgage rates started trending lower. So if rates keep coming down, we could see more buyers jump back in the market, which might push prices up again. So if you're wondering how this all ties into your buying or refinancing plans, let's connect. DM me or call me at the number below. I'd love to help. Thanks for watching. I'll see you in the next one.